When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news! You found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shea, and I'm just here to ask the questions, but the words of wisdom and solid advice come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how's the weekend treating you?
So far, so good. I still have this voice issue or something. I don't know what I got living down there in my throat, but it makes me talk kind of funny, and I'm still powering through. But getting the work done, I don't feel sick and feel like things are just fine. But I may not sound like it. But here we go.
That's okay. Well, okay, we'll just keep you an hour or so this weekend, Jeff. I understand that the S&P 500 and the Dow Jones Industrial Average closed for the first time in record territory. What does that mean for the average investor? And can you give us some information about what's driving these markets?
I don't know. Fundamentals really haven't been around. And I don't mind the momentum. I don't mind seeing the trends. I don't mind the fact that there's more buyers than sellers. I do get a little curious, at the fact that more of the buyers are what we call tourist investors who don't really know anything. They just buy because they're told on the news to buy. When we've got 95% of insider action, which means CEOs and, company owners are actually selling right now and have been for, months. I talked about the $500 million that Mark Zuckerberg sold with Meta, with, almost, a little over under $100 million just from the CEO of Apple selling. The smart money seems like they're selling and buying bonds, kind of going into protective mode. But, we have certain things that are happening that are in the market that don't make a lot of sense and certainly are not backed by fundamentals. The price earnings ratio is so far out of whack, and we're overpaying for these stocks. They're so overbought, like at unprecedented levels, which usually means, ready for a really, really big crash or retracement. We've got tons of bank problems happening coming up, probably starting in March, stemming largely from higher interest rates that have to be repriced by banks. People that are paying 2% and 3% are going to have to be refinanced at 4 or 5 or 6. And, with a lot of things that happen, especially in the real estate market, they're going to have to be repriced, probably won't get the loans that they want. And there might be some big defaults there. A lot of companies that are barely hanging on at lower interest rates are going to have the interest rates jacked up, basically variable loans we're talking about. And the banks are going to have to, restructure their debt. And I think there's going to be a huge problem coming in March, not to mention, the Fed monies that they have in the repo fund, which is basically runs about $2.5 trillion in Fed monies that allow banks to, carry their debts overnight. Basically, it's the overnight rate, kind of the Fed funds rate that banks use. I just read a stat that said that they're down to under $1 trillion. They're actually like at 800 billion, and they look to go very shortly down to about the 600 billion, which means it's about a fourth of what they normally carry. And that's kind of the emergency money. How's a bank's going to raise emergency money for, loan defaults, credit swaps, the different things that they have to do? Now, just within the next couple of months, I think there's a lot of trouble on the horizon. So, banks, I think some of the banks, like Bank of America, who just a few days ago said, Apple's going to $250, buy Apple. And so everybody goes, oh, let's go buy Apple. Well, once Bank of America and everybody else is selling Apple. They're not buying it to $250. They're selling it to the suckers. And so this market has been very manipulated by just extra liquidity. Also, something that was kept stealth until recently. It's come to light that a lot of the bank bailout money last year was to the tune of trillions of dollars to help some of the regional banks when the SVB, the Silicon Valley Bank, went out of business, and it was it Renaissance or some bank that followed them, and a couple others got in trouble, and some that we didn't hear about, couldn't support their deposit requirements and either went out of business, had to merge, or got in some trouble. So the feds bailed out most of the big banks so they wouldn't go into trouble. A lot of the regional banks are still struggling and may end up failing, especially with this debt crisis, credit crisis that's just really near on the horizon. Apparently, about, I think the number was 2.4 trillion. I probably should double check before I start spouting numbers out, but it was trillions in kind of a stealth QE program. So which is totally counterproductive to the whole idea that we're tightening monetary supply. So there's not as much money out there. We don't want to have too much liquidity because, that just creates inflation. It goes into the market. I mean, look what happened last year. So, all these big banks, turns out, were buying the 4 or 5 big power stocks in the Magnificent Seven, the Apples, the Microsofts, Googles, Meta, and basically, just cranking up their own profits with government-funded money as a bailout, and kind of spurred on the growth of the indexes as we know them, mostly generated, as of November, I've mentioned this before, 10% of the stocks, or just basically those Magnificent Seven, contributed to virtually all of the gains in the S&P 500. 500 stocks, yet 7 of them are making all the gains because of the way they cap weight them and because of the way that the banks got this free stealth funding to continue to buy and basically market make these stocks, which drove the stocks up. Even when earnings on the S&P 500 last year grew at less than 1% total from start to year to finish of the year, the market went up like 30. That's the biggest disconnect in my mind. That is not fundamentally driven. That is basically market manipulation at its best. Powell comes in on the tail end of that in November and says, we're going to pause interest rates because inflation looks like it's coming down. Well, inflation's coming down, but it's still in the 4% range on top of the 20+% that we've had that hasn't gone backwards. It's still causing problems rippling through the economy. And there's always a delay in when these Fed tightening programs go into play and when the actual recession hits, because most people are able to spend savings. And then if the government prints a little bit of money and sticks it to the banks and lets them kind of fake the market out and buy their own stock back or buy the Magnificent Seven stocks and drive them up so it looks like the economy's great. Well, I'll just take you back to last Friday when we had a really big rally a week ago. The market had a really good upside. I think the Dow was up over a few hundred points. I think it was 400, and S&P up 40 or 50. Everything was up. And only 15% of the stocks, of all stocks, went down. 15% went up. 85% of stocks went down in what looks like a bull market. There is a big disconnect of reality, the economy, and what the market's doing. Yet at the same time, if you jump in on those big stocks and you're hanging with the banks that are manipulate the market, you're fine. But here's the deal. There's a lot of smart money that's going short the market. And what they do is they bid the stocks up to where the short sellers have to cover at a loss and they lose money. So they're squeezing money out of short sellers. They're squeezing money out of what we call the tourist investors who say, oh man, I'm scared to miss out. I got to jump in. And they jump in and they drive the market up. But there could be a sell-off any day. When the public doesn't believe there's going to be a recession or even a soft landing because they've been told that over and over again, that's usually right before big bad things happen. It's usually opposite what the general consensus is on almost every case. When the consensus is almost unanimous one way, it's an inflection point the opposite way. So there's a lot of things that are happening in the market that don't make a lot of sense, or certainly not supported by any fundamentals. I mean, they're buying stocks today as if interest rates are back down to 2 or 3, the inflation rate's down to 2. Somehow magically that's just going to happen, and the Fed's going to drop interest rates 7 or 8 times next year without causing inflation. Well, that can't happen. They're basically back to square one as soon as they start lowering the interest rates. We get inflation, then we have to raise interest rates again and tighten again. So we're looking at a no-win situation for the Fed. They've promised to lower interest rates, but if they do, inflation goes rampant again. If they don't, the market sells off because they've already expected these things to happen. And then when you get the bank problems of trying to reprice mortgages, to reprice debt, especially commercial real estate. That's going to be a big one coming up. But there's just a credit crisis where banks can't lend. They don't have enough money. The only thing that they're doing right now is, market making the big power stocks. There's going to be a time when they have to sell that off in order to cover their own losses in the lending world. And that's probably going to start happening in March. I'm not sure, I want to try to split the difference and jump in the market because I think there might be a little time for a rally between, here the mid to end of January where it's starting to go up again, which is, like I said, manipulation. And maybe we'll get a really good market during February, and it's going to make everybody feel like they're stupid for not getting in, and they're going to jump in just at the wrong time. I had a vision in my mind, kind of like whack-a-mole, all these big market makers have these big mallets and they can whack us on the head at any time they choose. And we're just the moles that we want to get in the game so we come out of our holes so we can play. And we come out and we play for a while. We don't get whacked, so we think, oh, it's safe. So we'll keep coming out. Oh, well, maybe we'll stay out. Maybe we'll get all in. And just as we do, here comes the big mouths. They whack us on the head and they put us back in our hole, and we're at a loss, and we're hurting for a long time. So we don't want to be the moles coming out of the hole to play the game when we're not the ones with the hammers. Somebody else is, and they can whack us at any time. So, as a safe money guy, as a protect your asset guy, I'm really scared of what's happening. I think it's just like the dot-coms that were overbought, that were oversold. They were oversold to us. They were overpromoted. AI is being overpromoted. AI is being promoted, yet no company is actually spending money on R&D. They're finally starting to, but last year they didn't spend any money. Shoot, they weren't making any money. And now the market assumes that all these companies are going to make 30 or 40% growth in their earnings to justify the 30% growth last year in the stock market. Well, what does that leave for this coming year? Another 30%? You'd have to have, earnings like go up somewhere to 50% or double this year, which I just don't see it can happen. We're looking at, the breadth of the market where most stocks are going down and less stocks are going up. Insiders, the company owners, board members, and insiders that know about their own companies are selling, not buying. That's just a recipe for impending disaster and doom. And I hate to be a doom and gloom guy. By the way, I'm the most optimist guy there is, but I also see a certain sense of reality. And I've been through this a few times when the market gets the best of the public by not telling the truth. Somebody wants to get out of a bunch of Apple stock, so they just go out and say, oh, we think Apple stock's undervalued. It should be worth $250. Everybody goes, oh my gosh, it's only $190. Let's buy it. Well, shoot, not too long, it goes to $125. That's probably when you should have bought it. And $195, that sounds like a great time to sell and take some profits, especially if we're going to have some sort of a correction period or even a roller coaster ride in this market based on a few things. One is the Fed's in a rock and a hard place. They're in they're screwed either way position. They can't solve the problem without QE, and that doesn't solve the problem. It takes us back to square one with inflation. They have to save face by lowering interest rates, which makes bonds look better, which is why people like Jeff Gundlach and PIMCO and all these other big bond guys are saying, man, we're just happy to be in bonds making interest. And, when the market sells off, we're going to double our money on the bond prices, and we're going to be the only winners here this year. So, most of the smart money, the big traders, the people that know how to brace for recession and problems are doing so, but they're not the guys that they're putting on the news because it's not a great story. It's not oh my gosh, the S&P just set a new record, the Dow just set a new record, we're at all-time highs, and this is the time to buy, this is the time to buy. Man, I don't know. Chasing the market's scary. Yeah, I wish I would have had a crystal ball and knew the Fed was going to give banks money to buy the Magnificent Seven a year ago and it was going to make the market go up 30%. Sure, with a crystal ball, I would have gotten in the market. We'd have been all in. But on the other side of the coin is if they would have kept tightening and companies were starting to, go out, more banks were starting to go out of business because, they can't lend at higher interest and companies are going bankrupt. By the way, at about 100% increase in bankruptcy rate from last year. So there's more companies that just aren't making it through this time period that looks like a great economy, which really isn't. But, the market still seems to defy that. And it still makes it look like things are better than they are. A lot of that, I think, is driven politically because the people in power, the White House, still has a little bit of leverage on the Fed to say certain things and to do certain things that make their prospects or their opportunity to get reelected a little higher. And I think they're doing what they can to do that. So, you can either bet on the powers that be to fake the market out and be on that fake ride, or you can take a little more of a defensive approach. Say, I can't afford to lose the million or two that I've saved for retirement or a big chunk of it, or even if it's a few hundred thousand or 100 million, whatever it is. If you can't afford to lose a big chunk of that, then it might be nice to just take a nice 5% yield on bonds and maybe even make 5 or 10% on growth of those bonds as a sell-off takes place and scared money starts running to bonds and bidding them up, which also makes the interest rates go down, by the way. But if interest rates go down a point or two, but you can make 10 or 12 on the bond prices, it's a great time to sell those bonds at a gain when the market's bottomed out. Nobody wants to buy, and that's the time we want to get back in and invest in the market on this next leg up. This last leg up last year, I think that's just it's kind of one of those what we call a bear market rally. The trends were still down until just recently. They only broke the 2-year trend just barely broke up just in the last, a few weeks or months. So it hasn't been like we haven't been in a downtrend for a while. We were just in a recovery mode for a bit, and the recovery mode was not supported by any fundamental drivers. And I'm still a little too old school to forget fundamentals at all, even though the market seems to have done that. But there is a fundamental that says not losing money is better than making a lot of money than losing a lot of money. So, slow and steady wins the race. I think we need to be the tortoise here in light of all the confusing information that we're getting. And again, follow the smart money, the billionaires that are taking money off the table. Warren Buffett, $200 billion so far he's raised in cash. That's a lot of money to not be in the market when the market's doing so well. Well, why isn't he doing it? He's smart money. He's going to buy everything cheaper later. he's probably going to buy some of these credit problems at discount and make a boatload of money like he did in '07 when he had a lot of cash, or '08 when the banking crisis happened. There's a lot of smart money that are preparing for the same things that we've seen before. And again, they've got more real life experience when they've been doing this 50, 60, 70 years than you and I do, not you and I, but a lot of the listeners who really have just done 401k investing. They finally got some money. The last decade was great. They made money on NVIDIA and all these great high flyer stocks. And, they don't understand how to brace for these recessions or how to lose half of their money. They haven't seen it yet. Most of them haven't seen it during a time when they're not getting a paycheck. This might be the first time. So if you haven't been retired for more than 10 years, you don't know what it's like to be retired, living, kind of having to depend on that investment portfolio to be your nest egg, your safe money, or your fallback position if something bad happens. But then losing half of that, that's going to put you in a very big predicament. If you've got a paycheck paying you $150,000, $200,000 and you can live on $100,000 and you've got $1 million or $2 million in the market in your 401k and it goes down half and you're still going to work 10 years, guess what? You'll probably make it back and you probably have a paycheck to live on in the meantime, especially having job security. So it's a totally different story if you're getting close to retirement. And that's typically the market that we serve the best is, do we want to chase the market? Do we want to be crazy? Are we having so much fear of missing out that we get mad because our friends on the golf course are telling us, they made 20% of their portfolio last year and you only made 5% because you were in bonds? Short-term stuff that didn't have any risk. Well, you can say, well, I didn't have any risk and that person did. And the market resets. Market sell-offs, the last couple of them, have, when the market's been stretched like it is this time, could be huge, 50% or better. So you might have made 30 or 40% of your money last year, which only made up the difference for what you lost the year before. So now you're back to even. You can still lose a half again. I think we're in a bad position to be, risking a significant portion of your money. And that's why I like principal protected products. I like short-term stuff that has a more predictable return, very limited risk or no risk at this time when there's so many uncertainties. And all of it's going to kind of come to a head probably by June of this year. And I think it's going to start as early as March.
We're talking with Jeff Volken of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we've been discussing the Dow Jones and the S&P 500 setting back-to-back records. It's obvious from this conversation that Jeff really, really does study this stuff and knows the things that will affect your investments in your retirement portfolio. So if you'd like to talk to Jeff about your individual situation, what you should do with your money to put you on a path towards a successful retirement, we're offering this retirement roadmap, which is a 5-point retirement review that includes an income plan, investments to support the income plan, also a tax plan, healthcare plan, and an estate plan. And we're offering it to our listeners this week, no cost, no obligation whatsoever. It's not going to cost you a dime. To get yours, call 520-780-9059. 520-780-9059. Now, you can make that call right now. You can make it this weekend if you'd like. Leave your information there, your name, your phone number. Shelley will give you a call back on Monday and set you up with an appointment with Jeff to answer your questions. Again, it is a one-on-one conversation with no cost, no obligation whatsoever. 520-780-9059. You can also request your retirement roadmap online at premret.com. That's PREMRET.com. Jeff, you mentioned earlier Jeff Gunlap, who is the billionaire investor and CEO of Double Line Capital. He says there's a 75% likelihood of an impending recession and potential widespread layoffs. What do you make of his prognostication?
Well, he's been right for many years on a lot of things. He's not a doom and gloomer all the time. He is kind of a bond guy, I will say, but they're listening to him because there's a lot of money flowing into bonds right now, and there's reasons for that. I used to quote Scott Minerd, who was the president of Guggenheim, was a big private investor, the biggest private equity fund out there, and he died, unfortunately, in his 50s, and so I can't follow him, but he was always right on the money. And another guy that wasn't too far off was from him was Jeff Gunlap, so I've been reading him a little bit more often lately. But 10 key insights to support what he's talking about, and he's estimating a 75% chance of recession. So I'll go with that, and I don't want to bet my clients' money that there's a 10 or 25% chance they can make 10 or 20% again this year. If it was more like 75 or 80, we take a fairly significant position, maybe with some of our risk money, our Wall Street money into the market. But when it's the opposite, you got a 75% chance of a recession, which means a sell-off, and the market is so stretched out that we could see 30 to 50% easily on that. The last two big ones were 50, and I think we're at that point where we are so overvalued that's not out of range. That'll get us just below fair market value, and it'll be actually a good time to re-enter the market. But for now, he's expressing a very bearish outlook. He knows that the Fed is really like between a rock and a hard place. Here's his 10 reasons for doing so, and I pulled the article up on the screen because I can't remember verbatim. But basically, S&P's returned to a double top after 2 years. That is either one of two things. One is it's going to hit resistance, which it kind of is still at right now. It did clear the 2-year high from 2 years ago, but it's never an attractive entry point for stock ownership because we've just, in order to get there, we've had this huge run up where a lot of people who bought early or bought low last year, especially all this bank money, this QE money that was kind of stealthily done without us knowing by the Fed to, basically promote their own agenda and that of those in power in the White House right now. Made the market go up, so it looks like everything's hunky-dory fine, and we got to keep Bidenomics alive so that the election will go right, blah, 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 blah. Well, there's a lot of people that know better like Gunlack, and there's a lot of smart people that say, you know what, it's time to sell. So you're going to have a lot of sellers in this market. It's going to probably be choppy from here. If it does go up, I don't think it's going to continue to, go up anywhere like it did last year. We're just kind of at that double top, kind of waiting out this election. And why there might be some upside in the market, I think that he's right, that there's a bigger chance that we'll have a sell-off before it gets better. And we may have a sell-off, which might encourage the Fed to lower interest rates in order to kind of prop the market up, especially before the election. But then as soon as the election's over, depending on whoever wins, and then they've got a big problem to solve, and that is what? Rampant inflation again. So there's nothing the Fed can do to stop us from having some sort of pain between now and the next couple of years, whether it's a market crash and then inflation, or whether it's continued inflation and somehow not a market crash because, we'll continue to prop the market up with either liquidity or at least a soft monetary policy to where the market still can be healthy by rich people while the middle class suffer with inflation and can't buy bread and food for their kids and have to get second jobs and whatever. So, the market's high. It's a double top, probably not a good entry point if you just look at, the charting and the stochastics and the different methodologies that are used. Again, maybe not so fundamental, but it is kind of a trend type thing. So if you look at the last year, the U.S. did not exhibit any type of superior performance. In fact, I just mentioned that their earnings, the corporate earnings on average were under 1% for the year. That's increases in earnings. That does not support anywhere near what kind of a return we got on stock investing or the increases in stocks other than the hype that AI might have, pushed people into buying stuff, whether they needed it or not. Our position as a global leader is waning. If we look at other countries, Europe, China's losing big time. But if you look at Japan, UK, most of the European countries, they're actually recovering a lot better than we are. And their earnings are actually growing when ours is not. So our position as a global leader is waning. That's point number 2 by Jeff Gunlack. We also expect slight underperformance for the higher performing Magnificent 7 stock. So you'd probably be better off buying an index that is evenly weighted, maybe even an even weighted version of the S&P 500. And you can get those on an ETF. You can't get the S&P 500 is so overweighted with the Magnificent 7. They actually use cap value weighting so that 7 stocks can actually be the entire upside and downside of the market if, when 7 stocks are worth what the rest of them are worth collectively. But we've seen somewhat kind of a stagnation, kind of a flat. There's been a little bit of breakout lately, but just in the last few months, we really haven't seen the full-on blast forward other than maybe Microsoft and NVIDIA. But, those even are looking like they're getting a little bit of top-heavy and maybe a little over bought. So I think we're going to see a downturn soon on those. Significant downturn in the dollar is also likely in the coming recession. That'll be a great time to buy some gold because usually when the dollar's weak, gold does better. Right now, the dollar seems to be holding its strength and, gold seems to be a bad investment at the moment. But the historical correlation between the dollar strength and the S&P performance is typically, negative. When the dollar's weak, it correlates negatively to the market. So the dollar is going to face some challenges just due to the policies that implemented because we have to implement certain strategies to mitigate what would be a potentially severe recession. We may still get that. But if they want a soft landing, like I said, I don't even understand what the Fed can do to create that other than just keep preaching that it's going to happen and somehow hope it does. So there's probably going to be a lot of volatility. This is another thing that Gunlack says. It's going to be, there's probably going to be a dip in interest rates initially, which by the way, after monetary tightening, if you look at history, after a period of monetary tightening, you get a loosening. In other words, we start lowering interest rates. We already went flat. We already said we're going to put it on pause. The recessions of the past, 8 out of 8 times in the last 40 or 50 years, especially when like yield curve's been inverted and the market's been doing similar things to what it's doing right now. When we see the Fed loosen monetary policy, it's usually after that first interest rate reduction that the recession actually takes place. It doesn't take place, and that's why they do it. They typically know crap's going to happen. They start trying to preempt it a little bit, but they're still always a little too late. It's going to be tough. I mean, I don't know how it's going to end, but I think we're in for a roller coaster ride. This is not going to be the straight up market that we had last year. We got a lot of things to consider.
If our listeners are interested in how the markets and what we've been talking about today will affect their retirement journey, once again, we're offering an opportunity for you to sit down with Jeff, talk about your individual situation. That number to call, 520-780-9059, to get your personalized Premier Retirement Roadmap. Once again, that number, 520-780-9059. Give it a call this weekend. Shelley will be back with you on Monday to set up an appointment for you to get your questions answered. Again, 520-780-9059. You can also request your plan online at premret.com, premret.com. Jeff, time for a break. When we come back, we've got listener questions, and boy, do we have some doozies this week. All that and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Welcome back to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Once again, if you've missed any part of the program, you missed our first part in which we talked about the economy, the market, and what's happening with the Dow Jones and the S&P 500. We're a podcast. Simply go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so that you can stay on top of your wealth and your journey towards a successful retirement. In this section, Jeff, we have listener questions. We've got 3 very good ones this week. They're rather extensive. We do appreciate people listening to us and sending us their questions. Again, you got a question for us, send it to us by going to premret.com and using the contact page there. First question, Patricia, listening to us in Tucson, she writes, I'm 76 and have been widowed since 1994. I'm retired. I have savings of $620,000 and SSI income of $2,200 a month. I also have up to a 5-year long-term care policy that would pay about $4,200 a month. My only debt is $900 a month on a $190,000 mortgage balance for an $850,000 home. I have no relatives to whom I would leave estate assets, and I'm considering various charities as estate beneficiaries. I have no close family or friends living in Arizona who are familiar with my current circumstances and finances and who might be able to manage my estate. I'm hoping to remain in my home, possibly in time relying on home health care for as long as possible. Do you have any suggestions regarding how I could manage my estate? Surely there must be others in my same predicament.
Well, there are. It's amazing. I do have a lot of people that either have outlived their children and spouses and don't have kids, or they never had kids, chose to, or weren't able to, whatever, and maybe they don't have an extended family that's been close to them. So what do you do? Well, if charitable giving is your best bet, here's what I would do is I would free up as much of that cash and equity in your house as possible. First thing that jumps out at me is if you're planning on age in place, you love your home, why not get rid of that $190,000 mortgage balance, do a reverse mortgage, get another couple $100,000 out that you can invest on top of your $620. And maybe now all of a sudden your monthly cash flow that you can spend and have some fun and maybe go out and try to find a few friends with $900 a month. Maybe you can, get active in some activities, volunteer groups or whatever where you get to meet more people and maybe have a reason to find a travel buddy or something and, enjoy some of that money. But you're probably just going to leave a big chunk to someone. If it's charitable issues, that's great. Most charities, especially the big ones that everybody knows about, have endowment counselors, and they have a situation where if you have one, let's say you're leaving half your money to the Heart Fund because of whatever reason, or Girl Scouts, whatever it is, or SPCA for, something, but whatever it is, you can go to them and you could actually have them be the trustee on your estate. And in many cases, they will handle the distribution of those assets. Here's the hard part is you have to be able to make sure that the charity knows that they're going to get a certain item, but you can put a charity on as a beneficiary on everything, including your home, including annuities, including your brokerage accounts, POD, pay on death, bank accounts, and so forth, so that on death, somebody else has claim to that. And if you give the contact information on that beneficiary designation form, generally speaking, if somebody will at least let those people know that you passed away, like maybe your favorite charity, they would at least make the announcement that you've passed and find a death certificate, then those accounts could make sure they reach out to the charities and those other beneficiaries to find out how they can make a claim on that portion of their money. So there are ways to get around it without really having to have a trust or hire a fiduciary or trust company to pay them big fees to pass out your assets. You can do it a little bit cheaper and easier just by listing each beneficiary on different accounts. Maybe each account just goes to a different charity as a beneficiary. And whether you work closely with each beneficiary and let them know what's going on. In fact, most accounts also have a notification alternate where, if something happens, and some people put their kids on this, but you could put even the charitable cause on it as your notify in case I don't respond to mail, etc. Mm-hmm. And then they would be able to look into it, find out that you pass and that asset is now theirs, if that's how you want to leave it. But again, what I see is you've got a lot of equity in your home that's not doing you any good. My opinion is you've already paid it down. You've already bought that equity. Why not just get rid of that mortgage, pay your taxes and insurance every year, live in it, but have a reverse mortgage, have a bank pay you out of most of that equity, actually have the money that you can use rather than you get sick, find out you have to go to assisted living, take the time to sell your home and all that kind of stuff. If you just leave the balance to a charity, even if you did a reverse mortgage for, let's say, $400,000, let's say when you die, the home's worth $1.2 million and the reverse mortgage you owe $800,000. Well, there's still $400,000 that is equity that would go to whatever that charity is, and let the charity worry about making the claim and getting the house back, paying off the reverse mortgage company, and selling it for a profit and keeping the balance. So it doesn't have to burden you or anybody you know. It could just burden the beneficiaries that you choose to leave all that stuff to.
Jeff, just as there is an executor for the estate of someone who has passed away, is there a similar type of position for a person who's like Patricia, who just wants somebody to handle things in the event that she cannot handle them because of her health conditions?
Well, yeah, and it would probably be whoever you'd put on a power of attorney. I hope there's somebody close enough that you would feel could at least make decisions for you for a health emergency or a financial emergency. I think that person would be a person that you would put on as a representative, whether you do a trust or a will. I would prefer that you don't go the will route because it's basically probate, and the courts will, when you don't have any heirs, you got charities all fighting for your money and stuff. I mean, they'll just milk that out for as long as they can, and lawyers are the only ones that win in those cases. So if you did some sort of a trust where you had all those beneficiaries, those charities listed, and all your assets go into a trust, you could hire a trust company or a fiduciary that you trust. People are actually licensed to do that and act in your best interest. Not that I found that they always do. Sometimes they do kind of drag their feet a little bit because they're typically charging you by the hour of how much time they put in rather than just a flat fee. If you get somebody that would just say, hey, I'll do it for a flat fee and it's just going to be, $5,000, that might be an easy way to just put somebody in charge. They know they're going to make $5,000 for maybe $50 to $100 hours worth of work. So they're going to make $50 to $100 an hour just doing something part-time that they wouldn't be, making anywhere else. So you can work it out. I'm sure you have somebody that you don't have close friends, but I'm sure you have somebody that you could trust. If you don't, look to the fiduciary world. You can probably Google it and find out, fiduciaries or legal representatives in your town. I would not hire an attorney, however. They're just overpriced, and they know how to bill estates when you're dead better than anybody. So be careful on that one.
Thank you for listening to us, Patricia. Once again, I would encourage you to give Jeff a call there at Premier Retirement. He's a certified estate planner. You can give him a call at 520-780-9059. I'm sure that between you and Jeff, you'll come up with a good situation to meet your needs. And, of course, we'll be sending you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Abigail, listening to us in Green Valley. And Abigail writes, my husband and I signed a prenuptial agreement before we married. This is my second marriage, his first. He has no children. I have one child who was an adult when we married, so there was no need for my current husband to adopt him. My husband and I live in a home that I purchased and maintained as my separate property. I've been careful to pay for all mortgage and maintenance costs myself to make sure that there's no question that this is my separate property. After I die, my trust directs that my husband gets the house, currently worth a net $1.2 million after deducting the outstanding mortgage from its market value, and my child gets the rest of my assets, which are also around $1.2 million. My husband will also get monthly payments from my pension as a survivor and beneficiary, which will more than cover my monthly mortgage payments. So my husband would, in effect, be paying the mortgage from the funds that I provide even after my death. I'd like the house to be given to my son after my husband passes. He is, after all, my son's stepfather, but he's not a blood relative. Would the house be considered an inheritance? If my son were to sell the house, would it have a step up in basis, just as it would if I had left the house to him directly? Or would my husband leaving the house to my son be akin to a stranger bequeathing the house to him? What's your opinion?
Well, it depends. If you actually give it to him and make him put it in a trust and you trust your husband to actually bequeath it. Now, keep in mind, if you actually give away the house, there is no guarantee and there is no reversionary right to you as a dead person or your son as a non-current owner to get that house. That would have to be done through a trust, and you would have to trust your husband not to remarry and have some greedy wife that talks him out of the house or whatever, and that kind of a thing. So, and that could happen, especially after years of you being gone and him having a new life. If that happens, that people might forget what was originally planned. So there is a thing called life estate where your husband never actually owns the house, but the mortgage is paid for by the residual pension, which is what you've done. Now, once you die, the step up in basis happens at the date of your death. So if your husband would get a life estate and be able to live there until he passes, your son or the trust that you leave the house in for your son's benefit, he would just have to leave the house alone, let your surviving husband take care of it, pay for it, and then your son would get that house at that particular time. My understanding is the tax law would require that any gain while your husband gets that growth, if there is a gain in the house while your husband lives in there, does end up becoming a taxable event on that portion of the profit to your son. But you could also make arrangements in the trust that any taxes or any basis would be paid for out of whatever the residual is left on the husband's estate, so that maybe it would offset that. There may be some sort of an IRS rule that I'm not aware of where, because he did not have access or constructive or any particular claim to the property, that step up would carry forward to the husband's death. I'm not sure that that's a rule. I'm saying that because I'm just not certain. I don't believe it is, but that's one thing I think just based on this question I'll probably take up with my advanced tax planning people, because that is an interesting question. On a life estate, does that step up basis continue to follow through? I know it would upon your death, and that's certainly a nice benefit that would pass on to your son eventually. And it also depends on how long your husband outlives you, if in fact he does. So again, I think look at a life estate rather than just giving him the house. I think there's too much at stake to just hand over the house and find out that it could end up not going back to your son when he's done using it, especially if he gets in trouble and just decides to sell it. Because if you actually give him ownership rights, he has the right to sell.
Abby, thanks for that question. Of course, we'll be sending you out Jeff's book, Retirement: The Road Ahead. Once again, encourage you to call Jeff and sit down with him. I'm sure that there is a good solution to your problem. 520-780-9059 is the number to call. Next question, Jeff, is Penny listening to us in the Catalina foothills. Penny writes, I'm a healthy 68-year-old retired widow whose husband passed away 14 years ago. I only owe $125,000 on my downsized home, which is worth $850,000 with a low interest rate. I get about $3,200 a month in Social Security. My portfolio, including retirement investment accounts and annuities, is worth about $2.6 million, but it's decreased over 20% the last year. My financial advisor says I'm in great shape and I'll have enough to last the rest of my life, but my portfolio is over 50% in equities, which doesn't seem wise. When I raise the issue with my advisor, a fiduciary who gets a percentage to manage my funds, he advises me to stay the course and not pull out of the market. He started withdrawing money from my 401k to ease the overall tax burden, but this year it'll put my income over $200,000, which will result in a higher tax bill. It's not really additional income as it's moving those investments into a Roth IRA. My husband was the financial guru and I'm at a loss. Does this seem like a decent financial course for me, or should I seek someone else's advice?
Well, I think just the fact that you're worried about it and you don't agree with your advisor means you should look for a separate advice. You don't have to take, it's your money, keep it that way. That's what we say. If you're not working with an advisor that has your best interest in mind, he's not a true fiduciary. And if you want something with less risk, he needs to do that based on your goals. His fiduciary doesn't mean he gets to impose his values on you. A fiduciary does the right thing for the client based on what he or she wants done. And all he does is a long-term portfolio, 50-50 stocks, bonds, and says, you're cool. Well, he can probably see that, you have plenty of equity in your house, you have a decent monthly income, you have very little debt, probably at a really low interest. And, based on your expenditures, you probably won't run out of money unless you keep losing 20% a year on your stock purchases, then you will. So with 2.6, if you make zero risk and make 3 to 5% for the rest of your life, Yeah, you'll never run out of money. But if you have money in equities that could crash 50%, that could be another 25% or so of your investments that lose value. And that's assuming the bond portion that you have and other things, don't lose money as well. So, I mean, if you want to, hold your neck out and be exposed to a $500,000 or $600,000 drop again, then if you get scared out of the market, you say, I'm never going back in. Now you've only got $2 million to work with, and you're going to be spending that down depending on what your lifestyle is. You may not end up outliving your money. I mean, if you're going to live another 30 years to 98, let's say you're 68, so let's say you live another 30 years, that puts a lot of pressure on that if you're trying to live on $100,000 a year and $3,200 a month in Social Security minus taxes, et cetera. So I could see you getting in a pickle if you leave it in a volatile world and continue to draw money out. I know you said you pulled the money out of your 401k to try to ease the overall long-term tax burden by doing a Roth conversion, but did your broker also talk to you about the fact that when your income's over $200,000, and you'll find this out very soon if you haven't already, is IRMA, the Medicare premiums that you pay are also going to go up, and they're going to stay up for at least 2 years every time you do this. Mm-hmm. So, even though you could probably get out of it and by claiming, this is just a one-time thing, it's not going to happen again. The IRMA increases sometimes give you a one-time oops it or write off or, hey, this was a special circumstance. But if you're going to do a continuous plan into Roth or Alert, which I don't oppose, but make sure you understand what the total cost of this is. My opinion is, maybe instead of moving a $200,000 income for 1 year, maybe you moved it to $300,000 for 3 years, have that high IRMA for only 3 years, but move enough of your assets out of IRAs or 401ks so that you have that stealth or that tax-free income going forward. That might actually keep you in the 25% or lower tax bracket going forward forever, rather than trying to stay in a 22% tax bracket now, only to see yourself going back to the 28 or 32 or 33 or 39 bracket, when the new tax brackets come back into play in 2026. And as you get older, in 5 years, you have to start taking out RMDs, required minimum distributions, from those 401ks and IRAs. So there's a bigger picture to look at here. There's also a ton of different investment opportunities that would be totally principal protected that he's obviously not offering. And I don't understand how people can call themselves fiduciaries, honestly, when all they do is stocks and bonds. That's just one asset class, basically. It's just Wall Street. I'm a fiduciary on Wall Street. I'm going to do the best I can and risk your money. Well, what if you don't want to risk your money? You can't be a fiduciary for that person. They could be a fiduciary for somebody that has a long-term plan, maybe, if that's all they want and that's all their values dictate, and they've got tons of extra income and they'll never run out of money and they don't care if they lose it all, then maybe that person could be considered a fiduciary. But there is a license that requires a fiduciary duty called the Series 65, which is RIA, Registered Investment Advisor. There's a lot of people in the brokerage world that do suitability or transactional business that get that license as an extra so they can call themselves a fiduciary because they have a license for it, but then they do all their work in this transactional-based, fee-based, and only risk-based business. That is, in my opinion, you're wearing too many hats and you're trying to straddle the fence between what a fiduciary is and what a fiduciary isn't, and somehow get away with semantics on where you're really putting your effort, and are you a fiduciary or not? Are you acting as a fiduciary in this transaction but not that transaction, and are you disclosing all those things? So I would say, just based on this question and based on how I feel that the tone is, that you're not very happy. Well, yeah, you need to kick tires. You need to find out somebody that talks your language, somebody that makes you feel happy, somebody that wants to preserve that $2.6 million and not ever let you lose it and make a reasonable rate of return for the rest of your life, knowing that not only will you never run out of money, but you're not even going to get close to drawing it down, regardless of how many corrections. Over the next 30 years, we could have 4 or 5 of these big 20 to 50% market corrections. If you're spending money out of that account, that's locking in losses every time. And you know what? Usually when that happens, people get scared. They go to cash far too long. When the market comes back, they don't get back in till the market's back up half of what they lost. And so you never really get back in the game, just like it sounds like you have. And if you're still down 20, you lost over 20% last year, either because you spent the money or because you had really underperforming assets and you weren't in the market. If you got 50% equities and they didn't go up, guess what? You don't have the Magnificent Seven. You've got stocks that went down. And of course, 85% of stocks are going down or remaining even, not up, even on days like, a week ago when the market was up 400%, was up more than 1%, and yet 85% of stocks went down. So, if you look at the S&P 500 last year, I believe more than half of the stocks that were in the S&P 500 didn't go up. They went down. Less than half went up, and only 7 stocks contributed to 90% of the gains by the time 2023 was over. So you're obviously not taking the right approach. based on what you've made comments. And yeah, you should get somebody else's advice. And I'd be happy if you started here.
Yeah, that would be a good idea. But the takeaway that I hear from this, Jeff, is that Penny's got over $3 million in assets. And with the annuities and the other investments, I mean, she's 50% in equities. As you said, she could live another 30 years easily with medical advancements and so forth. And with the market correction, she could run out of money. So I'm with you. I think the answer for Penny is to call 520-780-9059. Sit down with you because there's only so much information in this that we can gather. But she really does need to sit down personally with somebody and sort this out. So Penny, 520-780-9059. Request your appointment with Jeff. He'll be happy to talk to you. And again, we will send you out Jeff's book, Retirement, The Road Ahead. If you got a question you'd like us to answer on the air, get it to us by going to premret.com. Send us your question through the email portal there or through the contact page. And if we use it on the air, of course, we will send you out that book. Okay, Jeff, for those people who are listening to the program, they've just joined us. I want to make them aware that we're offering a no-cost, no-obligation opportunity to sit down with you, talk about your individual retirement journey. And again, no cost, no obligation for this. It's not going to cost you a dime. 520-780-9059 is the number to call. Do it this weekend. Shelley will get back to you on Monday to set you an appointment up with Jeff. You don't have to wait months to get in to see Jeff. Once again, no cost, no obligation, 520-780-9059. Or you can request your appointment online at premret.com, premret.com. Jeff, let's talk about crypto. I understand that Bitcoin now is available in an ETF, but Jamie Dimon called crypto the next pet rock. What does he mean by that?
Well, he doesn't think that it has really any, anything to do with anything real is really what that means. Jamie Dimon was talking to Davos. He keeps saying he'll never talk about crypto again. He basically back in 2017 says, this is just fake. It's just pie in the sky. It's just a joke. And so he says, I just call it a pet rock. It's nothing. And he says, wait, you know what? I think Bitcoin really does have some uses. They just happen to all be illegal, such as money laundering, fraud, tax avoidance, or payment for sex trafficking. It really is used for nefarious activities because it cannot be tracked as to who bought what where. There's no receipts given. It's just a password and you just move the money around. So, I have a feeling that this is how, our present administration is funding the terrorist groups. Some of that billions of dollars, could be Bitcoin that they're trading between Iran, Ukraine, whoever else they're supporting. It seems like we're kind of funding these wars to either create a distraction or to somehow create upheaval enough to where somehow we can not have an election and they can stay in power. I don't know what it is. I hate to sound like a conspiracy theorist. I'm just an observer making comments that sound realistic and potentially real. But Jamie Dimon says, it's basically just fake money. And, they're trying to legitimize it now by making these ETFs, exchange traded funds that can hold Bitcoin and other cryptocurrency. If you look at crypto, if you're talking about the money laundering scheme, all your Bitcoins that out there trading, they can buy these Bitcoins. Who knows where these Bitcoin or what this little password has been and what it's bought, but all of a sudden they're now sitting in an ETF that you get to buy that looks just totally innocent, and you're just buying it at a price and you hope the Bitcoin values go up, you sell it at a profit, and you try to just make it work that way. But there is some support to Dimon's claims, and the government actually has done a little bit of research and says that 15 of the 27 online commercial sex websites it examined reported exceptional digital currencies. So, that's more than half of the people that just on the website stuff is using digital currency. Well, why? It's because nobody wants to find out who that person is, probably because they're involved in nefarious activities. And it's not just, looking at pretty girls when they have a lonely weekend. It's maybe used for a little bit more nefarious activities, a little bit more deeper criminal type activities. So, not that I condone porn or commercial sex websites in general, but if you're looking at commercial sex websites, come on, man. That's like a can of worms that can lead to all kinds of stuff. Just if you just use your logical mind, right? So again, there's still a strong following crypto. I think people like the idea that it's private. People are, being told not to trust the dollar. I don't know what other currency you would trust. It's still the, currency of choice for most of the civilized world. So, until things really break down, I don't know if crypto is going to end up becoming the winner or if it's going to be gold or maybe just bullets and food, So I don't know what, how far our economy or our world can melt down. I think, if you're biblically focused, that there's going to become an Armageddon and some sort of an end of days scenario that I hope isn't too soon, but you never know when it's going to happen. That, things will get bad. We understand things will get bad. You look at the geopolitical events that are happening and it seems to fall in line with just really stupid people making stupid decisions and stupid policies that are supposed to support themselves, but as they ruin the rest of the economy and the mechanism that supports all of their power, they're going to destroy that. Then what are they going to have? I don't understand how they think they can win on this. It's just a matter of too many greedy people letting greed and their own carnal desires to be rich and powerful override sensibility and, normal decisions. So I think Bitcoin came out of that as a way to kind of circumvent the system and get away with more crappy stuff. I think Diamond's right on the money.
You're listening to Jeff Vogan of Premier Retirement Planning and Wealth Management. I'm sure that, Jeff, a lot of people listening to the program today have had their interest piqued by a lot of our topics. S&P 500, Dow are setting records at this point in time. The possibility of an impending recession here in 2024, they keep talking about that. We've answered some great listener questions, and of course, we've talked about cryptocurrency. Again, we're a podcast. If you've missed any portion of the program, you'd like to hear it all over again, simply go to wherever you get your podcast, search for Jeff Vogan Premier Retirement, and you will find our show there. And again, 520-780-9059 is our telephone number, 520-780-9059. Highly encourage you to sit down with Jeff. Take advantage of this opportunity to get your questions answered and request your Premier Retirement Roadmap. No cost, no obligation. Once again, 520-780-9059. Make that call this weekend. Well, Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our listeners here in the Tucson and Phoenix area for joining us. For Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.